Brian, thank you so much for sitting down with me.
Oh, it's great to be here, Dani. Good to see you again.
I just want to start, one of the things you've been very consistent on so far this year, whether it be conferences or in your earnings, just the strength of the consumer.
Right.
And the strength on your platform. Yep. Spending on credit and debt up 6% year over year, yep. And yet gasoline prices are high. Right. Consumer confidence is at rock bottom. Yep. If those types of things can't break the consumer, then what, if anything, can at this point? So
I think, just to give the stats, about $2 trillion goes from our consumers in the economy every year. About $5 trillion. Year to date's $2 trillion plus, growing at 5% in the aggregate, debit card to card a little faster. And it's going everywhere. Now, when you watch within that, you start to see your point about what consumers do. They're going to the gas station more times and spending a lower amount because they, from a budgetary basis, they don't want to spend that much. But they're still buying more in entertainment. It's up 13% year over year in the month of May. And so it's a little bit of a conundrum. And why is that true? Go back to your question, what would break them? Unemployment 4.3%, job formation not as strong as theoretical numbers, but for the population growth, it's actually pretty strong at 60, 70,000 jobs a month. And so our team thinks we'll grow at 2.1% this year. And people say, well, you're optimistic. I'm telling you what the consumer's doing today. But what they say they're going to do will come true if job cuts really come through to lower levels of employment. Right now, a lot of these job cuts are open positions and attrition and things like that. They're not necessarily huge layoffs that are actually affecting because job numbers are going up.
Well, I know in your earnings you also noted, I think spending on gasoline was something up like 16%.
20-some percent.
Okay, it's 20-some percent. Is that something you're keeping an eye on?
Well, keep an eye on it. If you sort it by low, medium, and high income earning households, it obviously has about twice the impact of a lower third of income households than it does a medium or the higher. And so that's where you have to watch and make sure that they are able to carry that. And that's the people who go in the gas station more often, still spending the $40. So they don't get as much gas for it, but they go more often and they ration how they spend it. They go to the places where gas is cheaper, let's just say that.
Right.
And you can see people micro-changing. They're going a little bit more to big box retailers, a little more secondhand stores, and all that adjustment is part of the K economy we talk about. But the reality is the incomes are growing for all those income segments. And so affordability is a real issue, but to fundamentally change affordability, we're going to have to build more housing, so there's the supply pressure will bring the prices down. Affordability, gas prices at $4.50 or above. We've been there before, so it is affordable. It's just not pleasant.
Someone once made the comment to me, Meredith Whitney, as a matter of fact, basically said a lot of people are leaving the banking system that are especially on the lower income scale. They're turning to things like payday loans. She brought up the term shadow banking. I wonder if there is, or if you are concerned that maybe there is unseen stress in the system that has left the likes of a Bank of America.
When you look at the recent Fed data on consumer credit, the reality is that there are pockets of delinquencies that are a little higher for subprime credit. We as a company don't do that business. And our credit's as good as it's been in 50 years on the consumer side, and it's getting a little better. The flip of that, though, is we offer a set of products, a no overdraft account where you can't overdraft because you don't have checks, frankly, and what you do is all automated payments. We have a $5 a month account. We have a $500 loan where you pay no interest, no fees. You just have to pay it back. You can borrow it a couple times a year. So we're always working on affordability of our products. And our overdraft fees are $10 versus the market of $35 for those that choose to have overdrafts. So we have an affordability package in banking that's second to none. And if you look at our consumers, from the spending side, they look like everyone else. From the borrowing side, we tend to be more of a prime lender. Right. So you'll see some pockets. But even those pockets, if you look at some of our peer companies that are in those businesses, the delinquencies are fine right now. Everybody's worried about what happens next, but it all comes down to unemployment and people being employed and earning money.
Well, the other side of the economy that's going absolutely gangbusters is everything in AI. And it's really impacting capital markets, and Bank of America is very involved in a lot of these deals, whether it be blockbuster IPOs, Alphabet looking at raising equity, upping their amount from 80 to 85 billion. I wonder what impact you think that happens on the market, just because of the sheer amount of capital and things that are being issued. Is this something that the market can absorb and can absorb smoothly?
Well, it's absorbed it smoothly so far. And the debate will be whether at some point the revenue and the earnings multiples and the cash flow multiples all have to come in sync. And right now you're in that phase where there's a mass amount of capacity building anticipated of demand. And so when you look at it, one of the ways that we think about is we are a buyer of these services, and a big buyer. $13 billion in technology a year, $250 million this year in 26 on AI-related spending. And so the question is, what's the affordability of that? That will be the interesting question, how all this comes together. But right now, it's a heck of a stimulus in the economy, that going on. But the other part of the economy that we see is the small and medium-sized businesses. And it's interesting. As you think about them over the last year we had Liberation Day, and that was confusing for people. And then we had the tax law finally got done, that settled confusion. Then had trade, then you had immigration policy, that confused people. The deregulation, they looked for that. As you watched in the fall, they're pretty sanguine. They said, look, I can see how this all plays out. And then a lot of it got put back on the table. And so I think what you see in the small, medium-sized businesses, there's a lot of uncorked potential there. They can borrow on the lines of credit. They're borrowing a little bit more. The loan growth's solid. They're mid-double digits and things like that, which is good loan growth. But they have so much capacity if they just had a little more certainty. And that's why they really want the war to end. So their input prices will come back down, because we see the gas pump. What really happens longer term is the products made with petroleum products come.
So they're kind of like through. At the gates, ready to go once
they're ready to go, and they just want certainty. Because if you're a big company like ours with 200,000 people, you have lots of people who pay attention to all this and tell you what's going on. Our research team, the best in the world. If you and I owned a business and we were doing something, you have to do all that work yourself. And the easier it is to do that work, the more time you can spend on creating the revenue. So I think there's a little bit of a pop left out there beyond the AI, which is an unbelievable amount of spending and et cetera. There's another pop when general business gets more confident about the future path.
I'd love to talk about your business a little bit as it relates to AI. I think there was a lot of excitement that you came out with this announcement that your intern and your college hiring class look incredibly robust. At the same time, I know you're speaking at Bernstein saying something like 14,000 employees internally would also be basically reorganized, relooked at thanks to AI, not let go. Well, what are the mechanics of that? What does it look like to sort of remake, not let folks go, but remake a firm that's equipped with AI?
So if you think, this has been going on for years. So when you think about your employee base, you have a group of employees a day. You have the attrition that goes on because people take jobs, they retire, et cetera. So you have that. That's in our firm's about 8%. So if you think about that, flip that, 8% times the 200,000 people means we have to hire more than 1,000 people every month to stay even in headcount. So that gives you a choice: am I going to hire replacements or not? The second thing you have then is the 14,000 people in 25 we took from one job in a company and put in another job through skills training. That's our own internal skills training. We hear about that in the public side, but we actually do it inside the company. And even in the technology, we have people who did product X and coding system X. They have now moved to code system Y and using these new techniques. So that all is about repositioning people. And so in the end of the day, we are moving mass amounts of people around.
Right.
And the key was we need young people. So we have 2,000 smart, brilliant kids coming in to be summer interns next week. And then 4 weeks later, we have 2,000 permanent hires, round numbers, coming in to be permanent hires. We've agreed to hire 8,000 kids from a community college in addition over the next 5 years. We agreed to hire 10,000 veterans in the next 5 years. So we're always hiring people into this company, trying to create opportunity for people from a community college to come to our company, finish their degree, and have a better
Brian, can I just ask very quickly, because I'm about out of time. This stuff is also really expensive. Have you started to think about just the inference cost of all this AI stuff? Are you asking people to pull back and keep track of it?
We're not at that stage yet because, frankly, at our scale, the number's not that big. We have $70 billion expenses. I can see where people run into this, but we have all 200,000 people have it to use. We want them to learn from it. That's just general usage, but the very specific applications like in the coding area and stuff, that's costly, but it's paying for itself. And we're pretty confident in the business trade. We wouldn't do it unless we saw the business outcome we want, i.e. that the revenue or growth will exceed the cost we put in. And so, but that will be a gating factor till people can really, really identify that. You have to say, wait, if I get all these costs and it doesn't come true, what happens? So we're measurably putting in 100 projects. We got another 1,000 we're looking at and all this stuff. But we're always gating those. Are they going to produce the revenue, or are they going to produce the cost savings that we're supposed to have?
Brian, thank you so much for joining. And by the way, I'm also looking forward to more World Cup announcements. I know you're giving away some tickets to veterans.
Yes, we just announced today we gave $2 million to buy $2 million worth of tickets to get a thing called VetTix for veterans and first responders, and that will. I'm sure everybody's looking for it right now. That comes live fairly soon. VetTix is a group that does other kinds of tickets that is owned by veterans, and they do it. So it's very exciting.
Brian, thank you again. Really appreciate your time. That, of course, Brian Moynihan, the CEO of Bank of America.